Hey everyone, welcome back to the channel. In case you don't, if you're new here, my name is Highly Rainey, highly recommended. And today I'm breaking down how I built my credit history without any shortcuts, scams, or hacks. But I have had my share of costly mistakes. Timeshare, anyone? Well, whether you're just starting out or looking for ways to boost your credit, this video is for you. Well, let's dive in. Well, before I talk about why credit building matters, let me tell you a story. Back in the late 80s, through my ex-wife, we had got involved with a timeshare deal because we thought it was a great idea to have a place to go vacation every year. I'm sure many of you out there have thought the same. But I'm just going to tell you about my timeshare experience. Now, this particular timeshare, the actual resort is in Europe. And so we were concerned about that. It's like, whoa, wow, Europe wasn't a destination for us to say that's what somewhere we want to go every year. But in the pitch for this timeshare, we were told that, oh, yeah, they're part of a very excellent exchange program with the company. I'm not going to say their name, but and so they say that it's no problem. You just put your 1 week timeshare in the pool, and then you can trade with someone else, and that way you'll be able to go somewhere else. And the benefit of that was, as they said, was that, oh, you can change every year. This way you don't have to, you're not stuck with the same place every year. Every year you got a chance to change it up. You can have some variety. And so through a little bit of the timeshare pitch, the generous, they don't exactly want to let you go until you sign on the dotted line. And so ultimately we ended up buying the timeshare. And it was nothing like they described. Number one, yes, it's true that you can enroll and put your timeshare, your week up, to be traded with someone else. What they didn't tell you was that's a separate fee on top of the finance. Oh, well, let me talk about the financing first. The financing for the timeshare, the interest rate was very high for even at the time. We're talking late 80s. Um, yeah, I think 1990 or 91, I believe. And so the interest rate was very high on it. It was pretty much an installment loan, more or less. I mean, I think the condo was like $5,000 for the 1 week. Um, and it was financed, and the payments were like 280 something dollars a month. But then they said, well, if you want to put your and on top of the financing, there was a maintenance fee, which I can't understand why, if we only have 1 week out of the year, why are we paying maintenance all year long? Again, another one of those things that didn't know about at the time. So then there was the ongoing maintenance fee. Then it was the idea of, oh, well, you can sign up with this company and then you can exchange. So it was supposed to be a timeshare exchange program. Well, there is a fee, a membership. There was a membership fee for that, and then you had to pay an actual fee when you did a trade, which was once a year because we only had 1 week. Didn't know about that, and then we did that the first year, and to try to get something else. And then we were told that, well, there was no demand for our particular timeshare opportunity. So, uh, needless to say, what ended up happening was stopped paying on it because we felt it was a scam. Took a hit to the credit and everything because naturally, like anything else, we stopped paying. So it went 30, 60, 90 days, defaulted installment loan. It's not a mortgage. And that's why I tell a lot of people out there, a condo, if you buy a condo, you do not own real estate. You only owe the right to use that real estate for a set amount of time based on whatever your timeshare agreement is. But you don't own real estate. Creditors should not be reporting it as real estate. It is not a mortgage. It is simply an installment contract, because that's all you got is an installment contract. And so I've had my share of mistakes. I don't know if I would label that one as costly. Obviously, it had a negative impact on my credit for a few years, on top of the issue I had with erroneous information from someone else's credit report. I talked about that in one of my other videos, so you can check that out. But I will tell you this: I fixed it along with the errors on my credit report. It took time, it took effort, and that's what it takes to build your credit and to repair your credit, which I'm not a big fan of repair, because to me, repair suggests patch, temporary, this type of thing. I believe in full restoration. I believe in working on the negative items and addressing all of them at the same time, efficiently and effectively managing your current debt so that it doesn't become future bad debt. And on top of that, show you how to use it in such a way to where you will get more opportunity for more credit, which is good for your score. And I just like to reiterate to people that getting better credit does not require massive amounts of debt. It doesn't require you going into more debt. It's just about getting more borrowing capacity. Like in the case of your credit cards, you would get higher credit limits, but that doesn't mean you have to go higher with your balances. Me personally, I've said it in other videos, because I have 3 business cards, 9 personal cards, and on my 9 personal cards, my credit limits are very high. They're 6 figures high, and I'm talking double 6 figures. But I don't have balances nowhere near that, because I only use a fraction of my credit limits. In other words, I have a very low credit utilization ratio. So, but the important thing is that by restoring your negative credit, effectively and correctly managing your current credit, and then using some strategies to build to get more future credit, that's how you build yourself to get to an 800 score. So, okay, now that I've talked about that, why credit matters, why building credit matters. Well, first off, why does credit history even matter, right? But I will tell you this: it's not just about loans and credit cards. Your credit score impacts many things. I mean, it can even affect your ability to rent an apartment if it's in a high rise with a property management company, and they do credit checks so they don't have to deal with future evictions and things of that nature. On top of that, a lot of jobs. There's a lot of employers out there now, especially with particular positions where they're relying on your judgment, and to make sure that you don't have any personal things going on that can have an impact on your decision making on the job. A lot of jobs should do credit checks now before you even considering you for the position. Sometimes with utilities, although most utility companies only are more concerned with your particular credit rating with them. But credit matters. It matters everywhere. It matters everything. If you're thinking about starting a business and you want business funding, in the beginning, most times that when you're applying for business funding, you have to do a personal guarantee. And even if you don't have to do a personal guarantee, they still do a credit check. So when I was starting out way back, like I said, back in 1986, when I first started as an employer, I was going to college and I worked too. And I got my first card. The first time, they didn't have secured credit cards back then. But I will tell you, that's where a good place to start. So, what's a secured card? In case you don't know, it's like a regular credit card, except you put a deposit down that becomes your credit limit. So there are cards out there. You give them $300, $400, $500. They'll give you a $300, $400, $500 credit limit, and then you go about using the card. You would want to use the card in the correct way, with that at maximum at the 30% credit utilization ratio. And then once you demonstrate that you good use of the card by paying on time, you building your credit. Not only are you building your credit on file for three credit bureaus, TransUnion, Experian, and Equifax, you are also building a track record with that particular credit card company. And so then they're deciding, will they trust you with more money? In other words, at some point they will offer you a credit limit increase. So they may increase you from $300, $400, $500 to maybe $1,000 or $1,500. And so then your security deposit, so now your credit limit far exceeds your credit limit. Some of them, even at some point, they will refund you your deposit altogether. And so now you have a totally unsecured credit card. Now, although my first card wasn't a secured card, it was just a regular credit card. I kept my balance low. I paid it off in full every month, even though back then you didn't really have it. Now, keep in mind, back in '86, when I first started with credit utilization, as we know it today, did not exist. That was something that came along after the mortgage meltdown in '08. And then over the course of time, because there were huge job losses in the financial sector, most of the people in the financial sector, how they handle credit cards back then is they would, you could use your card any way you wanted to, but if you paid your balance every month, they considered you a sure bet, and you actually got rewarded for charging your card up and paying it off every month. But after the mortgage meltdown, a lot of the folks who handled their credit that way, because they would put everything on there, it would be get their Sky Miles and all kinds of other rewards. So they weren't concerned about using cash, but they were high income borrowers. But many of them lost their jobs during the mortgage meltdown. And so they ended up being some of those people were the biggest majority of credit card defaults, account defaults, because they didn't have the money to pay and they were running them up. Again, many of them were maxing them out, and they were um, large balances. So as the credit bureaus always do, they're constantly updating the credit report scoring models for changes in the economy, changes in the marketplace, things of that nature. So what ended up happening was when the credit bureaus rolled out the updates in 2012, they took into account the high number of defaults due to people who were maxing out their cards but used to paying them off, but now they no longer did. So they no longer considered that demonstration of high income by paying balances every month. Now they consider running high balances as risky behavior, because now statistics say that someone who runs their balances up and keeps it have a high degree of probability that they'll default. So that's when the credit score utilization concept came along in 20 with the 2012 updates. But nonetheless, um, in today's world where the credit utilization makes sense, you basically want to show that you can handle credit responsibly. And so what happened for me is, back then, even though credit utilization wasn't a concept, I paid my payment on time every month. I kept my balances low, and I was everything was great. But then in 1980, in 87, I'm sorry, 88, I had saw it was a nice used car that was looking to buy. It was a Honda, and I applied for a loan. It wasn't even an expensive car. It was only like $6,000. But I applied for a loan to get the car, and I was denied. And I was like, wow, why? It's like, oh, well, your credit score and you got delinquent accounts. I said, no, I don't have delinquent accounts. I only have one account, which at the time was my credit card. And so then it took me nearly a year. Actually, it was a little bit over a year, because back then we didn't have credit monitoring and all the rules with the Credit Reporting Act that makes it easy for us to access our credit files. But it took me a year to find out, and it turns out that I had credit accounts on my file that didn't belong to me with similar last name. Because believe it or not, my last name is Rainey, and it's not that uncommon as you would think it is. Um, and then I spent nearly 2 years trying to figure out how to go about getting it corrected. Because back then, the only way to get your credit score, to get in touch with the credit bureaus, was to write a letter, mail it to them. There was no online presence. There was no electronic avenue. There was no phone. You could try the phone number, but all they would tell you is send a letter. You have to write a letter, and it had to be added to the file. So it took me over 2 years to get that corrected. And that took numerous letter writing to all three bureaus. And I was finally able to get them to put a note in the file, the check social security number and things like that. That was all you had back then, because back then your social security number was out there in the ether world, and it was the identifier for everything. Of course, a lot of you guys are old enough to remember a lot of times your employer ID number was your social security number. When you went to any government agency, your social security number was that agency's identification number for us, until they found out that was, the source of a lot of identity theft and things of that nature. So then that's when they started telling us to guard your SSN closely. Okay, but after getting all of that cleared up, I was finally able to finance and bought my first uh, brand new car. Then, okay, and so then later on, I continued to do that, made my payments on time. So I had the credit card and I had the automobile, made the payments on time there. Then when I applied for my very first mortgage in 1991, I started finding incorrect information again, and um, I had to go about working on that to get that cleared up. But I was eventually able to do that. This time it took a little bit longer. It was it took a little bit closer to 4 years to get other stuff cleared up, but it was a little bit easier because things were starting to change. There were new access for us, because this became a big problem. And so over time, when I started buying more properties, and each time when I applied for a mortgage, something popped up. Um, but it did get easier. And so eventually I got all that cleared up. By 1999, all of those items were completely cleared up, were completely together, and I didn't have any more issues with that, because I added it. The Social Security verification instructions seem to be the most effective in helping with that. But and so since that time, 1999 up until now, I have built my credit one account at a time, managing those accounts effectively to build it. I didn't use no shortcuts, no hacks, any of those things. But I will tell you some of the things that I did do that did work for me, and a couple that I know worked that I did not do personally. So the first of those is becoming an authorized user. This is not new. A lot of folks know about this. Many people I know often will make their children authorized users to try to give them a head start on building their credit. Well, it's a great idea as long as you do it properly. And by doing it properly, number one, you do, it kind of doesn't make sense to do it any earlier than 17 or 18, because at 16 they really won't count anything anyway, but it's still a good idea. But remember, any accounts that you put your children on as authorized user, make sure you're managing the account, because you don't want to have them as an authorized user, you miss a payment or you got late payments, and now you're starting off with bad credit. But an authorized user is an excellent way to do it. I mean, I consider it sort of as a game changer, because when you're building your credit, if initially when you're building your credit, if someone can make you an authorized user in their account, you get off to it. You do get that good running start. But you got to make sure that they have an account that not only are they paying on time, but that if it's a credit card, it's not maxed out, and the credit utilization is in line, because otherwise you don't want to be an authorized user on an account that's badly managed, where all you're doing is picking up, you're voluntarily taking on someone else's bad credit history. So you want it to be a good account. Again, I've never used it personally, but I've recommended it. I have many clients that have helped. People that came to me were already authorized users. And again, outside of what I said before, as long as the account is in good standing, it's going to benefit you. If it doesn't, you should take yourself off. Okay, because essentially, I mean, credit is all about borrowing, and authorized users essentially us borrowing someone else's good credit standing. Now, of course, we know the risk is you have no control over how the primary account uses their account holder uses their account. But if they're going for a good ride, you might as well ride along. Okay. Now, a the evil cousin to an authorized user strategy is buying trade lines. Now, I'm going to tell you, I never bought trade lines. I never sold trade lines. Um, 10 years ago, buying and selling trade lines was big business. There are still folks out there now still selling trade lines, but if you notice, the cost that they're selling them for is much less than it was years earlier, and there's a reason why. Trade lines are totally worthless, and here's why. Prior to the credit bureaus, well, I'm going to tell you like this: it's risky. Most of the time, it's unethical, and sometimes, in some cases, it could be illegal. Um, but again, there's a lot of people out there still selling it as a quick credit boost. But here's the thing: the lenders have gotten hip. The credit bureaus have gotten hip. Lenders see through the schemes, because they know if someone is an authorized user on an account that is close to their birth date, they know that's the case. But it's even bigger than that now. When they've realized that buying and selling trade lines was an industry used to artificially boost people's credits, who especially those who otherwise had little or bad credit, they saw right through the schemes. And then oftentimes, what they did, what the credit bureaus did, is now if you're an authorized user on someone's account who is not a relative, either direct relative or through marriage. And of course, we know with the secondary bureaus, LexisNexis and the like, they can easily trace your family tree to anybody that's connected to them. So it's not hard for them to figure out that if you're an authorized user on someone's account, whether that person is really a relative of yours. And if it's not, they're going to disregard that credit history anyway. So they're not going to take it off. They're not going to remove it. But guess what? There's back end notation that we don't see that tells the scoring model to disregard that account for scoring purposes, because they know it's probably a bought trade line. I mean, the lenders seen through the schemes, and a lot of them, if they find out, it can end up hurting your credit even more. How? Okay, say for instance, you got a credit card through a bank, and when the bank reviewed your credit and your credit score, there were accounts on your credit history that you got credit for that were authorized users from relatives from bought trade lines. I'm gonna say it that way: from bought trade lines. If it's discovered later on and openly said, and then the creditor themselves get direct input saying that your credit was extended under a false credit report, they could essentially say it's a breach of contract, cancel your credit card, and then close your account. And then the thing with that is, we all know, if any of you out there know, that when the creditor closes an account, especially with a balance, and the balance does get paid, now you got a new derogatory account. So your credit can actually be damaged by buying trade lines and then having those trade lines having your creditors revoke them when they extend credit that way, right? Now I'm gonna tell you like this: it's like anything else. People look for shortcuts and hacks, and people look for credit to be improved in steps. And I tell my clients, because I set the expectation early that building credit is a process. It takes time. I wish if there was a fast way to do it, believe me, I would have found it and I would have done it. Now I know there's a lot of people that try to get fast results through the disputing process. And, and that's a whole nother thing. I'm gonna talk about that in another video, but I would tell you this: when you're working on fixing your credit, you can't look at it like steps. Because of course, with steps mean every time we take a step or we make a step, we take action, we're looking for a reward. A lot of people look for a reward in every step they take on their credit. So when they pay something, they want to see their credit go up. If they pay something off, they want to see their credit go up and things like that. But when you're building credit, all of those things we're doing when we're clearing up stuff, whether we dispute it or not, or we remove it, we negotiate payments, pay it off, it's not incremental steps. Repairing your credit is like steps. Restoring your credit is like an escalator, whereas you're going to start out slow at the bottom, and then as you're going, then it goes up. It's a process. Again, and so if you want true, lasting transformation, change to your credit, it has to be done the right way. It takes longer, but it's worth it in the long run. It's worth it in the long run. Because keep in mind, credit reporting agencies, lenders, and credit card companies generally discourage buying trade lines for obvious reasons. Many lenders consider it just straight up deceptive because they say, you're getting credit under false pretenses. Some of them even go stronger and use the F word, fraud. They'll say, you're getting credit extended based on credit that's not yours, especially when you go in default. See, that's the thing. Back in the day, if you bought trade lines and it gave you a leg up and you did okay, then fine. It was expensive. I mean, because they were charging like $500 an account. And in my mind, the only way somebody would be willing to pay $500 an account to boost their credit to do something is usually if they plan on doing something illegal anyway. Because otherwise, how do you justify paying that kind of money for an artificial input? But that's just my thinking on that. But again, they can say it's fraud because you're putting it's not true information. It's prohibited. Many credit card companies have language now in their contracts that say when they extend you credit that the information on here is true and accurate. And quite honestly, if you have bought a trade line and there's credit reporting on your account, on your credit file, your credit history for each of the three bureaus that's not your own, it's really, it's not you. And so again, if they can't sue you or anything like that, but they can certainly cancel your account if they found out your credit score was artificially inflated in that way. And a lot of those companies that were selling trade lines and the ones that still do, no refunds, but again, because the value of it has fallen through the floor, the market for selling trade lines is not what it once was. I mean, it used to be, I think now they're charging 50 or $100 an account, but I advise you don't buy trade lines. They're not going to help your credit anymore anyway, because the credit score models are ignoring authorized user accounts from non-relatives. I mean, it's not illegal, but with all the risk involved and the consequences, in my opinion, it's just not worth it. Just do it the right way. Now, I talked about how building credit is a process that takes time. And it's like, like I said, I use the analogy of steps versus escalator. But I'm going to think of it more. I want you to think of it more this way. It's a marathon. It's not a sprint, right? I mean, for me, I built my credit through consistency. I kept my balances low. I paid my bills on time, and I tried, I avoided unnecessary debt. I was usually, very careful with, with that. But I recommend that anyway, credit or otherwise, because that's good financial management. You should always avoid unnecessary debt. The things, think hard about what you're going to spend your money on, your attitudes about money. And I think mindset is very important. Outlook is very much a big part of that. And the same positive outlooks that will help you with your finance and money can be applied to your credit too. Because at the end of the day, credit is a leverage. You can use it as leverage to magnify your money. Think about it this way. You may have a good income, but if you decide to buy a house and you wanted a $200,000 house, how long would it take for you to save up $200,000 to go out and buy a house? Well, it probably take you a long time. But as long as that it's still not, building your credit doesn't take it to borrow $200,000 to buy a house doesn't take as long as it takes to save $200,000 house. So that's why when a lot of people say, "Oh man, why it takes so long?" It shouldn't take that long to fix credit. Credit, repairing my credit, restoring my credit shouldn't have to take that long. Well, I tell a lot of people all the time. A lot of people spend years, you know, through missteps of ruining their credit. Then they live with it for years before they finally decide, okay, now I want to do something about it. Now I want to fix my credit. And then they talk to me and then they say, oh man, 6 months? Why does it take so long? I can't get it done sooner and a lot of that is based on what they're seeing on the internet. But I tell people all the time, you've lived with your credit being bad for years, but now you can't wait now that you're ready to do something about it, you can't take 6 months to a year to do it if it takes that long. It's not always the case with people. But my point is, it's not 6 days. It's not 6 weeks in a lot of cases. It may be anywhere from 90 days to 6 months, could be a year based on how it is. But guess what? It's still faster to fix your credit so that you can borrow 100 grand than it is to save up the 100 grand. It's still faster to fix your credit, and then your credit is not going to fix itself. Debts don't fall off in 7 years. People, that's a misquote. Bad reporting on your credit, your live credit debt, credit accounts falls off in 7 years. Collection debt, any of that does not fall off. It could fall off after 7 years, but that's 7 years from the date of last activity. And guess what? All the collection agencies are reporting your last activity every month. So the clock never really starts. So when people quote that your collection is going to fall off at 7 years, they got to keep talking. They got to tell the whole story. They got to keep going because they're quoting one part, but they're not telling the provisional part, which is based on the date of last activity. That's one. And I've told hundreds of people that. So I want to put that out there, that 7 year expiration date on debt is more than just 7 years. Because I always say, they say 7 years. Say 7 years from when? And then nobody knows that part. They always quote the 7 year part, but then I say 7 years from when. They never know because everybody that misquotes that never say when. So just food for thought. I'm sorry, it might have been a little bit of a rant there, but I just love to set things straight. So in short, we're gonna recap here. Start with if you want to build your credit and get you to an 800 score, start with a secure credit card. That's always the best place to start. Manage that account. Keep your credit utilization as low as you possibly can. And what will happen is, this is the beauty of it. If you keep your credit utilization low, 6 months, 7 months, 4, 5, 6 months after you open the card, they're going to say, oh, wow, he or she, they're keeping a low utilization. They're not hardly using the card at all, but they're using it regularly, but they're keeping it low. They're being responsible and conservative with their debt. We'd like to see them use the card a little bit more so that we can get more merchant fees. We don't want you to run up a balance, but we want you to use the card more. So what they'll do is, usually the first time, depending on where your credit score is, if you're in the 550s to 600s, they're going to invite you to apply for a credit increase. Usually then they'll want income information just to see where you're at. And then based on your income and what you've been doing with the credit utilization, they will increase your credit limit to a comfortable amount based on what your income is and what your outstanding debt is at that current point in time. And then you continue to maintain the low utilization and keep doing that. Every 6 months or so, they're going to be offering you additional credit limit increases. Then when you get to a point when your credit score is higher and you're in the 640s, 650s and higher, they're not no longer going to invite you to apply for credit limit increases. They're just going to give you credit limit increases because they're going to tell you how wonderful you are as their best customer ever. And they're going to continue to offer you higher credit limit increases. And as long as you keep your credit utilization low, having extremely low credit utilization ratios will help build your credit score faster because you're showing them you're really got a handle on your expenses. And I tell people out there, I guarantee if you follow that strategy and you manage everything else on your credit correctly, you will get credit limit increases. I have credit limit increases. All of my credit limit increases now are 5 digits. That means they're over $10,000 credit limits. I have some that are over $20,000 credit limit. And I did that through that strategy and build it up. And that's, to get an 800 score if possible. So that I will tell you, it works. It works. I've had clients follow that and they tell me it works. I had one client just early this past summer. Now her credit wasn't too bad. She was in the low sixes, but she wants to maximize her credit, not only for a mortgage, but she wants to build a house and then she wants to have the best credit she could possibly have. So then she said, I saw online, should I get another card? I said, no, don't apply for any more cards because she told me she had 2 Capital One cards. One was a secured card with $300 limit. The other one was a secured card with a $500 limit. I said, no, there's no point in going out and applying for new cards when you haven't even maximized these yet. And she said, well, how will I do that? So I told her, this was in May. I told her the credit utilization ratio strategy, keep it low, keep it tight, just put a few things on there. I said, in the next 3 months, they'll be offering you credit limit increases. Well, didn't quite take as long as I thought. It only took her till the end of June, and she got a letter at the end of June. Both her cars were with Capital One. I'm not promoting them anything, but that's a fact. So, and she told me that, and I actually have the text message, and she said, "Oh, Capital One, my $300 card, they raised my limit to $1,500, and my $500 card, they raised my limit to $1,300." And she said, "Oh, this is so wonderful. I'm glad you told me this. You're magical." And I said, well, I'm not exactly magical, but I know how they do. But she followed that strategy and her credit limits did increase. And I told her if she continued that strategy, they will continue to increase. I have told many others that strategy and they have all had similar results with that. But again, back to the recap, start with a secure card, keep your credit utilization low. If possible, become an authorized user on a relative's positive reporting account and avoid ineffective hacks and shortcuts like buying trade lines. But most of all, be patient, be strategic. Like most good things, your credit file and your scores will start to build slowly. Let's talk about bamboo, because I talk to my business clients as well about this when we talk about growth and being patient. A lot of people don't know. Now, there are various species of bamboo, but one thing they all have in common is that when that bamboo seed is in the ground, depending on the species, it could be anywhere from 4 years to 15 years. That seed, the first 4 to 15 years of that seed's life, it's underground. It doesn't shoot out the ground. It's in the ground, growing out a huge, massive root structure for 4 to 15 years. It's just growing underground in the dark under the dirt. So if I planted some bamboo and I'm like, oh man, I'm watering it every day. It doesn't seem like it's doing anything. Nothing's happening. Nothing's happening. But say, for instance, that one species where it starts to grow on year 4. So suddenly year 4 comes around and all of a sudden it pokes up out of the ground. And finally, it's ready for the world, so to speak. No pun intended. But guess what happens after that? Once it emerges from the ground, that stalk starts to grow straight up, because I don't know if you know, bamboo is actually in the grass family. It's not a tree, it's grass. And so that bamboo starts to grow, and it grows straight up at an average. I think it grows about 3 feet a day, 3 feet a day, until for 60 days, it grows straight up. It grows, 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 grows. So all of that, and it's able to do that because it has this huge network of roots underground that it spent 4 years developing. So credit is the same way. Now, it's not exactly 4 years, but if you do all the foundational things up front, and even when you're repairing your credit, you might spend 2 months, 3 months doing all these things, and you don't see a lot of huge improvement to your credit, but these things are all working behind the scenes. And then when they all work and they start to, change and do things, then boom, your credit improves by leaps and bounds. Very similar to that. Now, of course, the time horizon is not that long, but my point is this: when you exercise patience, when you're building a foundation, when you're building, and that root system, once you got all that in place and it's ready, it can handle all your growth. It can handle all your improvements. And that's how your credit is going to be. I mean, things will snowball, and that's where a lot of people go wrong, because they think every single action they take to improve their credit is supposed to translate into a score increase right off the bat. That's where a lot of the companies that sell you financial products related to credit, that's what they want. And yes, you want to have wins. I know you want encouragement, but trust me, if you take the time and you do all the right things, the credit score will come. Because remember, better credit means a better life. Now, if you found this video and the information in it helpful, please like and subscribe and share. More importantly, I'd like for you to share this with other people. But most important of all, please put comments below. Tell me if what you liked or didn't like about this video, if there are other things you would like for me to discuss. I'm going to be talking more too specifically about mortgage building, because I got a lot of clients who are trying to fix their credit for the explicit purposes of buying a home. But I think all the credit rules should apply regardless of what your intent is. But again, thanks for watching. Please like and subscribe if you found this useful, and I'll see you in the next video. Take care. Bye.